And looking at the renminbi, and this was recently added to the IMF's drawing rights basket. What does this mean for China?
Not a whole lot, in my view. I think that it's triumph of symbol over substance. What matters for China in terms of the role of the renminbi in the global economy is not the imprimatur of the IMF. What matters is China's relationship to the global economy, and in particular, whether China is willing to become a mass exporter of currency to provide to the rest of the world. That implies running either very large trade deficits or exporting a great deal of capital to the rest of the world. That basically involves turning China's existing growth model on its head. And it's not clear that Chinese leaders have really wrapped their minds around what that would imply. So the declaration of that the renminbi is part of the IMF's SDR basket, it may have been a rhetorical victory, but it raises more economic questions than it answers.
But with IMF's seal of approval, if you will, China does now face pressure to step up efforts to liberalize its currency, as you said, and indeed broader financial and capital markets. So how is it getting on with this? Are there any particular sticking points?
The impact of SDR status will be more of a psychological one on China's own policy formulation. So for instance, if it does encourage them to liberalize financial markets, then that could be a positive thing. But there are a lot of substantive barriers and obstacles to actually following through on those liberalization plans. The other impact that it could have is on China's currency policy. There's been a lot of speculation over the whole course of the year about whether China would engage in trying to devalue the renminbi in order to try to boost its domestic economy. I think that is probably off the table right now, a large sudden devaluation. Because first of all, it would squander all the real or imagined soft power gains that it got from joining the SDR basket, but it would also be extremely disruptive, given the commitments that they've made. On the other hand, the quote-unquote move to a more market-based basis for valuing the renminbi, in particular, moving away from a dollar peg to a basket of currencies, has laid the foundation for China to allow depreciation of the renminbi, slow depreciation, particularly if the Fed's move to raise interest rates in the United States causes the US dollar to appreciate. So basically what they've said is, if the dollar goes higher, we're not on board, and we will allow the renminbi to depreciate gradually with other currencies against the dollar. I don't think that's a good thing, but it's better than a sudden devaluation, which could really spark a currency war.
And if China fails to meet expectations on transparency and financial reforms, the country could even risk losing credibility or even its place in the IMF's basket. Do you think this could be likely?
Well, I think it puts them under pressure to deliver on some of the reforms that they've promised, yes. But, I think that they've got a lot bigger fish to fry domestically in terms of opening up the barriers or the risks of opening up their own domestic economy, in particular the financial system. I think there's always been a lot more anticipation about what China's aspirations are for opening its economy and opening its financial system, and they run into a reality of what that would imply, especially in terms of real openness and financial accountability within China.
And for the global forex market, what does the renminbi's emergence mean?
If they engaged in a sudden currency devaluation, I think they could be very disruptive. Certainly, it would be incredibly discrediting to the IMF that they allowed China to join the SDR basket just prior to a large devaluation. That's one of the reasons why I don't think it's going to happen. The more likely path of a gradual depreciation still has implications. It may not send the kind of jolt through the global financial system that a massive devaluation would, but it still lends itself to the headwinds that have been felt, particularly by the U.S. economy, from a stronger dollar. It's had a headwind on the U.S. trade gap, which has increased, and it's had a headwind in terms of the value of U.S. corporate earnings. So to the degree that a depreciation of the renminbi intensifies that or contributes to that, I think what it shows is a lopsided global economy. A global economy where instead of unlocking demand in countries like China and in Germany, which can really afford to demand more, there's this persistent reliance on the U.S. consumer to try to be the locomotive that drives the entire global economy. In the long run, I think that's very problematic.
Finally, overall, looking towards the year ahead, what do you think China will be focusing on?
What they should focus on is they should focus on reform and getting the Chinese economy on track, even if that means lower GDP, even if that means some financial disruption. Unfortunately, I think what they will focus on is just trying to keep things together, and that will come at the expense of some of the reforms that need to take place in order to revive the Chinese economy long term. I think the danger is that rather than facing a financial crisis or an economic crisis, that China prioritizes just trying to keep everything stable, and that they end up being more like Japan in the 1990s, where instead of a crisis, you just get stagnation and you get lower growth, whether they admit it or not, and you get a lot of zombie companies, a lot of zombie banks that aren't actually driving growth anymore.